So the banks came out with the stress test results. Annually, you do these stress tests, making sure they're secure, they're fine, to withstand so many different things. Cover that in a second. And in short, as expected, all the banks passed the stress test. Now, these banks, they have around $175 billion combined in excess capital. That's how easily they pass. Now, to put that in perspective, it equates to about 10% of the average market cap. So, in other words, let's take JP Morgan, right? Largest bank in the world. Its market cap is $460 billion. That's $46 billion in excess capital that it has now. And what are they going to do? They're going to buy back a lot of their stock, increase their dividend. They just made a recent acquisition. They paid a few fines, I think they announced. Some like a platform that wasn't as regulated. We don't admit to doing anything wrong, but here's a couple $1 million to the SEC. You know, they all have that worked out, which is all cool. But when I put the entire thing in perspective, and this is a story that's not being told here, because I saw an interesting quote from, this is a Federal Reserve president, he's from Minnesota, Neel Kashkari. So Kashkari has a nice history. He was the former intern head of the Treasury Department's Office of Financial Stability, right? So he oversaw the Troubled Asset Relief Program. That was during the credit crisis, which bailed out every major bank, right? He oversaw it. So he knows exactly what's going on. Now, after these stress test results, he comes out and says, this is right after they're released, that the losses in the banking sector were much smaller than expected because governments were aggressive in providing fiscal support to families and businesses affected by the COVID crisis, which I agree, right? You gave everybody money, so it wasn't a big deal what happened to anything. It was just, hey, let's give... Guys, $10.5 trillion more is coming. And I say the government, I include the Fed in the government because the Fed is the government, right? I mean, it's the same thing now. We know that for the past, how many administrations? Donald Trump controlled the Fed. We see Biden administration. I mean, they control the Fed, right? The Fed operates based on who's in office, right? So it's supposed to be separate. It's never separate. But now we're looking at $10.5 trillion in checks. So I agree with him. I definitely agree with him. Then he said they should have even higher requirements, these banks, than are already in place. Because banks cannot expect the government to bail them out of every crisis. This is Kashkari. This is what he said. Okay, wait a minute. Higher requirements. Right now, the annual stress test for banks, and these are put in place after the credit crisis, call for banks to have enough capital to withstand a 10% plus employment rate, a 35% drop in commercial real estate prices, and a 55% drop in the stock market. This is put in place, just percentages that they throw out there. I don't know how they calculated them. But to put those three events in perspective, together, they've only happened once in our entire history. And it wasn't during COVID. Commercial real estate held up well. Stock market did not fall below these levels, below 55%. It didn't happen during a credit crisis. Stocks fell around 35%. You have to go back to the Great Depression between 1929 and 1931, which means that these events are never, ever going to happen together. And even during COVID, if they do happen, we have a government that's just going to throw trillions at the market anyway. So why do you have these requirements in place for the banks? When you're going to bail them out anyway? You say, no, we're not going to bail them out in the future. I mean, Kashkari, here's a newsflash for you. You're the asshole that bailed them out. Being in charge of TARP in 2008, you know the whole system. Come on. And where are we today because of these new rules put in place for banks, which you had a hand in? Well, let's revisit that. In 2007, pre-credit crisis, JP Morgan had a market cap of $140 billion, which fell to around $70 billion before it bounced back up in 2009. Every bank got nailed. Some much more than JP Morgan. Back then, I'd only even give you the $140 billion in 2007. You guys, Fed, government, deemed them too big to fail at $140 billion market cap. Now we look at today, because of your requirements you put in place, which, by the way, you want to increase. You just said you want to increase, right? JP Morgan has a market cap of $460 billion, almost 3 times as large. And you're saying banks can't expect the government to bail them out of every crisis? You have to. If you couldn't let these banks fail whenever, 10 plus years ago, during a credit crisis, when their market caps are 25% of what they are today, how in the hell can you let them fail in the future? You can't do it. So you know what? Stop grandstanding. Stop the bullshit. We see it from a mile away. Oh, they need higher requirements. I mean, if you look at the banking industry, it's one of the only ones, and believe me, I'm getting to a bigger point here because I'm going to make you guys a lot of money. It's going to be very, very simple to make money, okay? I'm going to explain it to you. Because if you look at banking, it's one of the only industries where the main players will remain dominators forever. They have no competitive threats. In other words, you're not going to see a mid-cap bank suddenly grow into a mega-cap. It's not going to happen. You can't have a Citizens Financial or Key Corp, these are like large regional banks, expand to the point where they have a greater market cap than the JP Morgans, Bank of America's, and Wells Fargo's. The current laws don't allow it. It doesn't allow it. That are in place. Hey, Facebook, $1 trillion company, came out of nowhere. Google at one point. I mean, you create the right company. A lot of times these guys get bought out early on because there's so much cash in the balance sheets of technology companies, but you have a shot to become an industry leader and disrupt. You're not disrupting banking. I mean, it's got to come from the top because even if you do, you'll get bought out, but there's laws in place that they're not going to have competition, which is insane. But you're looking at the stress tests. So the stress test, when I say the current laws don't allow it, here's the biggest requirements. So the biggest requirements, which are for any bank that holds more than $250 billion in assets, right? This amounts to 23 banks. So this is the biggest requirement that they have to have on the books. So the biggest requirement, it's called Common Equity Tier 1 Capital, CET1 for short, okay? I'm going to make this very simple. I don't want to get too complicated, but it's very important you understand this. It's the core capital, which is common stock, retained earnings, preferred stock, a bank holds in its capital structure. And the CET1 ratio, it's a very big deal with stress tests and banks. I know if you don't know the banking industry, you're like, what the hell is this? I'm explaining it to you. The CET1 ratio compares a bank's core capital against its risk-weighted assets, which simply means this determines a bank's ability to withstand a financial distress or crisis, which they put in place, which is the 55% market collapse, 35% drop in home prices or commercial real estate, and they put those measures, whatever measures are put in place by regulators, right? So again, I don't want to get too complicated and lose you here, but regulators require that a Tier 1 capital ratio should be at least 4.5%. So just know 4.5% is a big deal. So lower and you fail. Now, I don't know if anyone took a look at this stuff. A few people did, a few analysts did. But I'm going to put something in perspective so you understand how powerful these banks are. So if you're looking at the minimum CET ratio, 4.5% across the board for all these 23 banks, you're looking at an average. They're above the average by over double. So by 10%. So you're looking at 4.5% minimum for Bank of America, it's 11.8%. For Citibank, it's also 11.8%. For Morgan Stanley, it's 16.7%. What does that mean? That directly leads to capital. So the 11% for Bank of America, again, trying to make this simple, the number you really need to know is it amounts to $25 billion in excess capital based on their market cap. So if you take JP Morgan, it's $13 billion. Now, JP Morgan's a bigger company, so it's not a big deal. But here's where it gets crazy. When you're looking at these numbers, JP Morgan, Bank of America, Morgan, they have Citigroup, they have massive market caps. But if you're looking even at a Wells Fargo, so their capital ratio, the CET1, again, minimum 4.5% below that is bad, came in at nearly 12%. That amounts to $32 billion in excess capital, which is 18% of their market cap. 18% of their market cap, which they could use for what? To increase dividends, buy back their stock, and acquire companies. Now, 3 stocks from this, but they all passed very, very easily. Again, the average passed by 10%, but there's 3 stocks, Wells Fargo, PNC. So PNC amounts to 17% of their market cap. So they have $13 billion in capital, amounts to 17% of their market cap. But the big name here is Capital One. So Capital One has $22 billion in excess capital. If you compare that to that market cap, that amounts to 32% of their market cap. Think about that for a minute. I mean, you have $100 billion, you have a little over $30 billion that you could only use, really. You can't really use for too much, right? You could acquire some companies, but now they've got the green light to buy back a ton of their stock and to increase their dividends in a zero interest rate environment where the banks already pay pretty good dividends. So when you're really looking at the numbers, that these guys are reporting, the stress tests are meaningless. No one's ever going to fail it again. And we just went through COVID, and they were immune for COVID because the government said, here's $10.5 trillion. We're going to bail out the world. And they're going to do that every single time we have a crisis going forward. Every single time. Why? Because they haven't seen the consequences of being wrong. The credit crisis, they were right. Hey, what were the consequences? Nothing. What? Higher debt? Who cares? Does that stop stocks, equities, household wealth from going to record highs? No. Same thing with COVID. Let's just throw money at it. That's why I'm so concerned with inflation. Because inflation is something that the Fed can't control by throwing money at it. They actually have to do the opposite and take money out of it, which is going to be extremely, extremely painful and result in a lot of stocks, especially high PE names, getting wrecked. I'm still on the fence. I warned. I don't think this is transitory. I hope it is, but if it's not, we're going to have the Fed raising rates, stop buying bonds, stop throwing money into the system. It's going to get a little crazy out there, guys. You're going to see a market that you're not used to over the past, 12 years since the credit crisis? But more important, anyone telling you that another credit crisis, I'm not saying we can't see a 10, 20% market pullback. We could easily see that, depending on what happens with the economy and jobs and whatever. But I'm talking about a credit crisis. So anyone telling you another credit crisis is coming, which we heard from how many bears over the past 10 years, it's coming, look at debt levels are crazy. Again, you don't have to worry about debt at all. The only thing you have to worry about is if it's being paid and paid on time. And it is. And it is. And the banks just reported that in the stress tests. Loan loss is going down. Things are better. But anyone telling you another credit crisis is coming is either trying to sell you something or is just an idiot that doesn't know how to read balance sheets. Because again, you look at the banks, loan losses are down incredibly across the board for the banks. Excess capital at record highs. Net interest margins have gone higher. I'm not talking about margins for technology companies. These guys, their net interest margin has a lot to do with interest rates. So interest rates go higher, these guys usually make more money. Banks make more money. It's good for banks in terms of profits when interest rates go higher. They increase that spread, that net interest margin. They found a way to increase margins in the lowest interest rate environment in history. I mean, just a guess here, it might be generating a lot of money by giving you zero interest on your checking accounts, but charging you 20% interest on your credit cards. That's probably a pretty good thing for them. Or the enormous amount of fees you have to pay to send a wire, transfer money, fees on their investment funds. I mean, these guys make fees about, you have their money there and you're paying fees for everything. If you're filthy rich, they give you all the breaks. If not, they wreck you. But the banks, they've never been stronger in the history of our nation. The environment has never been better. Where how many institutions and businesses are borrowing money like crazy? Consumers have more money than they ever had. And they're paying this off. They're lending money like crazy. Go nuts. Household wealth at a record high. Massive buybacks coming. Much higher dividends coming. And inflation, which we all see coming, is going to result in higher rates. Which is going to increase their net interest margins. Which they're already doing well on. And the kicker here, banks, holy cow. I mean, you see what they're trading at? JP Morgan's trading at 11 times forward earnings. Wells at 12 times forward earnings. Citi at 8 times. Goldman Sachs at 8 times. You can say, well, that's where the sector trades. Yeah, that's fine. But banks, especially investment banks, holy cow, they're growing earnings much faster than the overall market. And again, they're going to increase buybacks, increase dividends, which are already large. People are dying for income. And from a risk-adjusted basis, banks, by far, not even close, is the best sector you can own. Nobody's even close on a risk-adjusted basis because they're buying back stock. They don't have to see massive growth in their earnings to see earnings go higher because they're buying back their stock, take more shares off the market. Now I know something. I know that you hate banks. And I get it. I mean, what they did to cause a credit crisis. I mean, take on excess leverage without anyone knowing behind the scenes, even the regulators didn't know. So they inflated profits. Why? To pay themselves huge bonuses. They all made out like bandits. It was great until it wasn't great anymore. And everyone was on the take. Everyone. Insurance companies, credit rating agencies knew the deal, mortgage originators who basically sold any loan. You needed, how much money you got in the bank? Just, is it positive? Yeah, have $50. Okay, you're good. What kind of ID do you have? You have a library card? Okay, here's a $600,000 loan. Why did they do that? Because they made the fees off of that and then gave the loan to Freddie and Fannie and unloaded the risk. A government organization that doesn't really freaking pay attention, just like the post office, right? Same thing. It's why the post office loses billions and billions and billions of dollars every year, yet UPS and FedEx, their profits skyrocket because they don't care. They don't care. It's not run like a business. It's run as, hey, let's just try to do the right thing and hire certain people and whatever. That's our government. That's why the government sucks at running businesses, because there's no checks and balances ever. You can lose as much money you want and don't worry about it. We'll give you more. It's fine. We got it. We'll get it someplace. Now look at the infrastructure bill. Infrastructure bill is coming out. What is it? 9% of the bill is infrastructure? Are you kidding me? And we all know it. We all see it. But getting back to hating the banks, I mean, these guys almost crashed the entire global financial system. The entire financial system. And what was their punishment? What was their punishment? After generating hundreds of billions in revenue and these guys generating millions of dollars for themselves and those bonuses, a few $1 billion in fines. No jail time for anyone. No way. And the Fed, what do? They put laws in place to make these banks even stronger than they were pre-credit crisis. That's why it's a joke. Kashkari saying, oh, well, we're not always going to be there. You can't expect us to be there. You have to be there. You don't have a choice. If they were too big to fail, JP Morgan's too big to fail at a $140 billion valuation. Don't you think at a $460 billion valuation, it's definitely too big to fail? You don't think these are too big to fail? They're always going to be too big to fail because it's a limited sector. It's 23 banks. You have the large banks. No one can be, it's not going to be spread out. You're not going to diversify the risk. They're all intertwined somehow or another. You're always going to bail them out. Just say it. Just say it. Have the balls to say it. So yes, I understand most people hate banks. I think they're assholes as well. But don't ever let your emotions get in the way of your ultimate goal. And what is your ultimate goal as an investor? It's to increase your household wealth, to retire early, to make sure your kids are taken care of. That's everyone's goal. I don't care if you're a Democrat, a Republican, all investors, that's what we want to do. We want to build our wealth over time and make sure our families are financially secure and their families are financially secure. That's everyone's goal. That's what we all want to do. That's a one universal that we could all agree on.